here to tell us whether we've turned a corner is Nick Sargen. He's CIO of Fort Washington Investment Advisors. He oversees more than $27 billion there. He joins us now live from Cincinnati. Good morning to you, Nick. Is this rally going to?
Good morning, Margaret.
Are we going to survive earnings season with this rally?
Oh, I think so, Margaret. One of the encouraging developments that I really thought, played into the strong third quarter was that many people thought with such a weak economy, how can profits be improving? In fact, I'm a great skeptic of Wall Street analysts always being too optimistic. And much to my surprise, the third quarter numbers not only exceeded, but what I've been focusing on is actually the profit margins of the companies, and that's really where it's come from. And as we all know, though, it has not come from the top line, it's come from the bottom line. And I think that's the real debate going forward. I think profit margins, and you're going to beat earnings expectations, but when do you see that top line growth?
Right, and how long does Wall Street's patience hold out when it seems to be just cost cutting that's helping to meet earnings?
Yes. The way I look at it again is that for those who are bearish and think this is crazy, what I come back to is I say two things. Point one, the valuations right now certainly aren't cheap as they were 6 months ago, but they're not egregiously expensive either. So I think we're probably in fair value zone on valuations. I think what certainly props you up is consider the alternatives. Do you want to go back into cash and earn zero, not just for now, but the foreseeable future with the Fed on hold? So I think that as long as then, again, you beat earnings expectations, that keeps you in the game, that supports the market. But to really propel this market much higher, to what would get me excited would be top line growth. And I think we're several quarters away.
So if we don't see that, though, does that put this recovery or this rally really in question here? Because there are questions, when are corporations going to start hiring again? When are they going to start spending again? And whether or not unemployment is truly maybe a forward-looking indicator in this environment.
Yes, and I think that, first of all, on the unemployment situation, this was, everybody says, the worst recession since the big one. And that's true, but really it wasn't so much the decline in output. That we saw in the 70s and early 80s. What really distinguishes this is the job losses being so much greater. And, if there's the optimistic side would be that businesses overreacted and maybe start hiring again. I don't think this year, but maybe into early next year. And if that is the case, then you can tell the momentum building with some comeback in consumer spending. The but is that usually it would show up in the meantime in smaller businesses hiring. And I'm not seeing that yet. So I think, Margaret, that I don't worry about the double dip this year, but I think there's a potential for a fade early next year.
So if there is a possibility of a fade or of a correction, short of going into cash, which you already said you don't like, how do you position yourself?
It's first of all, again, the easy money's been made. What we liked most of this year was we said let's play the debt side rather than the equity side, because there the corporate spreads and high yield spreads were at record wides, and that play has worked out beautifully, I think, on a risk-adjusted basis. Right now, our view, though, is that it's tough to see further spread compression. So I still like corporate bonds, investment grade. I still like high yield, but I just tell clients they don't expect those double-digit returns, but they're going to do better than treasuries and cash. And then I think on the equity market, my advice is be close to your normal allocation.